Alrighty, guys, it is 3:30 this Friday, April 4th, and it was like almost like bloody Friday, bloody crazy freaking sell-off meltdown kind of a mode going on. So that was a technical analysis. It was a very professional analysis, but that's kind of what it is. Market is like in absolute free fall, trying to figure out what to do. The reaction to the tariffs and reaction to I guess flat out fear mongering. So they are forecasting doom and gloom, and the market is reacting to it. That's kind of what's going on right now. And I can't say I'm overly worried about it. I think this is a massive overreaction, but it is a reaction. You can't deny it, and you can't do anything about it more than try to trade it. Um, and the futures today, I mean, as I said this morning, I would just stay out of it. It's just too volatile. So I haven't traded it today at all, no trades at all. And I'm glad I mean, my chart has been lagging. It's just not handling the amount of volume coming through. We have 2.2 million on the 2.3 in the micro ES, over 3 million in the micro NASDAQ. There's like 2 or 3 times the size of volume, 3 million on the ES. So it's a massive amount of volume coming through. And trading it today is just a fool's errand. I think it's just a matter of how much money do you want to lose. If you get lucky, you get in on a trade and it doesn't just stop you out, you'll be smiling. But you try to do it a few times, you'll get caught, and then you just give everything back. But overall, that's so no trades on my part today. But the overall analysis is just flat out. We are heading lower. Price discovery territory to the downside. Massive move out of the middle. Most happened in the overnight. But you can see here we started off the day at the 54.20s. We are trading at the 51.50s right now. So we are like 300 points down or so. And it doesn't look like we're getting a lot of recovery yet. So market is repricing to the downside, trying to figure out the tariff impact. And we'll just have to wait and see how the market figures starts calming down. It's still the volatility is there, and I'm just expecting a pretty crazy start of next week as well, the way this looks. So trading from the short side at this point, I'm gonna have to go back and do some analysis on this because the levels obviously get absolutely blown through here on the way down. But you can see we have a ledge here at the 51.40s. We have one here at the 51.15s. Um, the mode is at the 52.10s right now. So I'm gonna have to kind of go back and relook at this. But no matter what happens, we're going to be trading this from the short side to going into the overnight Sunday, Monday. Today's trading has been flat out to the downside. And yesterday set the tone in the overnight. We also got the major move to the downside, which has absolutely has started this whole thing off on the wrong side. But you can see we are definitely in a pretty weak spot at this point. So trading from the short side of the market at this point, and no reason to do anything else. We are in almost in bear territory right now. So from 61.50, let me see, 61.50, a real quick calculation. And we are looking at you see 61.50. That will take a 49.20 takes us to bear territory. So if you trade down to the 4900s, we're in bear territory. So we're pretty close, like 17% to the downside right now from the highs. So pretty gnarly stuff going on. Don't look at your 401ks. There's not much you can do about them at this point, unless you had protection already going into this. But then again, I mean, I was the way I was looking at it, I was buying at 10-15% pullback. I started buying at that point. But this last tariff sell-off, I'm gonna say it's no more money to buy again. So you get your reserve, you kind of bought too early. You go figure. No more normally a 10-15% correction is way there. It's an awesome opportunity. And now we're like at 20%. It's like, yeah, okay, great. If I knew, I would have changed my strategy, but woulda, coulda, shoulda. At this point, though, on the futures trading, I would just wait for it to calm down a bit and see where we can get some sort of resemblance to normal trading. You can see we started catching up here later in in the latter part of the day, starting to slow down a little bit, but it's still lagging. I mean, the charts are still lagging though, so I'm not going to be too aggressive on this at all. So, but I would trade it from the short side of the market. If we start seeing some good news on tariffs in terms of tariff negotiations, we may see a nice snapback develop. But it's at this point, unless that happens, I think the market is going to be just keep having it hissy fit and do what it does. and you just want to be out of the way. Don't aggressively trade it. You'll be just blowing up your accounts or losing a ton of money. Because it doesn't really matter. And the point is, it doesn't really matter if you're right on the trade. There's so much volatility. So if you want to try to get short against this little pop here we're looking at, if you want to get short against that one, you have to have you stop outside that rotation, 52.15s. That's a 30-point stop. So that's how big it needs to be. And then that gets you kind of right. So if you want to trade with a 30-point stop, that's pretty big. I trade with a 5-point stop. So I'm not going to do 6 times the stop size to be able to trade this. It's going to be other opportunities when the volatility comes down a bit. So I would do a trade if I had to double my stop. That's kind of my pain limit. But if I had to do bigger than that, it's just a recipe for yes, keep scaling in and a 30-point loser and you'll be us crying. So that's where we are on the ES. So traded from the short side of the market. At this point, I have not traded today. I've decided not to get engaged this market. It's just too volatile, too crazy. I was looking at the bonds for a bit, and they have been pretty good. They've been very much tradable on the bonds. A little bit volatile, but very much tradable. A few different opportunities on the bond market. But it definitely is a tradable market. So that's not that bad. I just opted not to trade it this today, given that all my charts were lagging due to volume. I figured that just kind of take it easy and not trying to be too overly aggressive. Even the bond market is, I mean, it moves pretty good. So if you're on the wrong side of it, you have to have maybe an 8-tick stop to be right. That's a $250 stop to be on the right side. So it's pretty much, it runs up there on the loss sizes if you're on the wrong side of the bond market, even if it moves pretty decently. You still a 8 to 10 tick stop takes it down in the $250, $300 loss range. So just have to be cautious about it. But you can see how the retests, reverse retests are working pretty good on the bonds. It is a great market to trade. It honors edges very well, and it's usually pretty good to trade. It just the tick size is pretty big on the bonds, like $31 a tick. So on the Nasdaq though, but I would say I would trade bonds on the long side going into the overnight, range bound. At this point, it's been pulling back a bit, so I'm watching it. They took out the London low at the 120.22, so we're back range bound. If they trade below the 120.05, maybe start looking for a retracement trade on the downside, but I'm still looking for long buying opportunities on the bonds for rotations back up again. Still feels very much like a flight to safety is going on there. On the Nasdaq, it's even worse. That crazy. I see it's starting to lose track of it now. It's absolutely too volatile. So I'm just going to sit on the sidelines and not try to be cute about this. But we were down. We were all the way down. Look at it on Capital Flow. We're all the way down here to the 17,500s. I mean, that's how crazy today's trading has been. So 17,500s. We were up at the 22.5 or something like that. So 22,500. 80% of that is 18,000. So we are well into bear market territory on the Nasdaq. 20% down on the Nasdaq. So a lot of people getting their heads clipped, and when this happens, when the market is like this, if you're trading on margin, you'll be getting margin calls, especially on the stock market. If you borrow money against margin and you're in positions, you'll be a margin called, and then you had to pony up money or they take your positions off. So it's stuff like that, it kind of skews the market a bit because there's a fair amount of that happening when the market moves like this. But overall, on the Nasdaq, traded from the short side of the market, I don't have a good sense of where to shift the bias. You can see on the bigger picture on the Nasdaq that we have. That's not a good picture either. You can see the volume. Most of the volume today has been spent below 18.2. So if it starts trading above that 18.2, we may have a shot for a retracement trade. But you see this, it's kind of building value here between 17.6 and 18.2, which is like a 600-point range. That's crazy, that is. So I'm not trading it until it starts calming down a bit. I can see I know things are keeping up and we have reasonable bar sizes. Otherwise, it's just a fool's errand. All right, so that's the ES and the Nasdaq. Just stay on the short side of this until we find a good base of support, and just keep an eye on the headlines because you can start seeing some tariff headlines like, yeah, we made a deal, we're dropping tariffs against this country and that country. you'll start seeing the market recover pretty freaking fast. So, and then when the market figures out that this whole thing is a trading, is a big negotiation, then maybe they'll figure something out. But you kind of had to realize that the market is stuck in a paradigm where the free money was printed and sent out by the government in massive amounts. Trade was, we were absolutely on the wrong side of the trade equation. And now we are basically taking that bitter medicine of readjusting the economy. And one big thing in this is the bond market, the yields coming down, long-term yields. If they come down, remember, I don't know if you remember, but we have a massive amount of debt which need to be refinanced, which, the Yellen was buying up all on short-term paper, and that's coming, that stuff like that needs to roll over into new debt. And so getting the bond price gone, the bond yields down, the long-term yields could give you a nice opportunity to refinance that. But all those things are side effects. Is there's still a very bitter medicine to take to get off that free money train, which we've been printing money and spending money we don't have. And that's kind of what's happening now. That bitter medicine is being taken. And you can see how the market reacts to it. It's not liking it one bit, not one bit. So I went back to the ES. I was going to go to the oil and gold. So oil and gold, gold has been behaving kind of okay, not too crazy. It has been tradable, but as they took out the gap and they are back down here. So gold definitely a big move to the downside. And that is you kind of counterintuitive, right? It feels almost like buy the rumor, sell the fact kind of dynamic. But gold took out the whole gap. They're back down here at that 3,030s. That's kind of where we thought it would go if they cleaned out, took out that 3,100. Now it hasn't been by any means a straight shot down, but you can see here as they took out the 3,100s, we definitely took it all the way down there. So I've been looking at maybe taking a gold trade today, but given everything else lagging, same as the bond, it didn't want to get in there and find out that, oh, you're lagging a bit on gold and you have bad entry. So that's kind of where we are on gold. So they pulled back to value at the 3,040. So I'll start off range bound around that value. Not necessarily looking for further continuation to the downside because they are at an attractor. So I would just start off range bound on gold and then watch these lower ranges. If they start taking out the lower volume edge, about 3,000 here, it's trading below the 3,000s. That's when you start worrying about the further continuation to the downside on gold. But at this point, they're at an attractor area. So I would just stay range bound on gold going into the overnight. And oil, they're starting to retrace some of these single prints right now, but they're up in the 62s. They were all the way down to the 60s. So oil, massive repricing on the downside, down to the 60 level, pulling back a little bit, not surprisingly. But that will take gold, oil prices coming down like that. But that, I think, is more global recession fears, if anything. I think Saudis also said they're going to put out more increased production was one part of it as well. But oil, I would stay on the short side of that if I could. It's at this point it's a little bit too volatile, same as the ES and Nasdaq for me to trade. So it's going hard to get a good read on it. But you try to get short on the way up here, you just get stuck twisting in the wind. You really had to be on top of it. And if you're going to trade it, just trade with a reasonable size stop, and then be prepared not to mess around too much with it. Let it stop you out if you're on. So oil and gold range bound, oil I would still trade from the short side, even if we may have a little retracement going on there. Same in the Nasdaq and ES, we may have a retracement going into the close, hard to tell yet. But we're getting into the last 15 minutes, so back to the ES. And this week has been one of the worst weeks in a long time. So it's not too often you see moves like this in the market, and probably a lot of new investors which has just been buying the highs and seen the market trade higher on free money, is getting a real wake-up call in terms of market corrections. Anyway, it is what it is. So we'll wrap it there for now, guys. You have a great weekend. I'll see you back on Monday and see how crazy it's going to get. Alrighty, guys. Later.